Welcome to videos that will be supporting our session number 2. First, let's look at the comic related to this chapter 3. Could you put me through to the quarterly statement review translation department? I think that's the feeling that many people have when they look at financial statements. They're just confusing and they need help to understand them. Hopefully, after this course, you'll be able to make it through without a translation department. So in today's video, we're going to look at an overview of financial analysis, then look at examples of ratios by category, and this will be kind of the heart of the matter in this particular chapter. Third, we're going to look at some other tools that are useful: trend analysis, common size of balance sheet, common size of income statement, and percentage change. And as a wrap-up, we'll do a couple of comments on the use and limitations of our financial analysis. When we approach financial analysis, we break it into 4 steps. Since we have a focus on free cash flow, we're going to start with gathering data and then jump right into the existing statement of cash flows and see what we can understand about the cash coming from the 3 activities. Those again being operating, investing, and financing. Then we'll dig into initial review of the returns, return on invested capital, and then go into the full-bore financial analysis, ratios, trends, etc. As far as the usefulness of ratios, they're useful, but don't think that they tell us all the things, and we cannot be deceived occasionally from using ratios. They help us look at one company over time. So often we call this trend analysis. Over typically 3 to 5 years is a good time horizon for most financial review. The other is to use financial ratios to compare your subject company with another competitor or with an industry average that might exist. And who uses financial ratios? Well, obviously they're used by lenders to assess the creditworthiness of a particular borrower. And it's used by shareholders to see if how their investment is doing and whether they should continue to invest or should they sell the stock. And managers internal to the company will use it to analyze the results of operations and spot things that may be strengths, weaknesses, or opportunities. We're going to jump into ratios now. The first set we'll look at are called liquidity ratios, and those really answer the basic question of, can the company meet its obligations? Very simply, can the company pay its bills? The first ratio is the current ratio. That's the most common of all ratios, and it answers the question of, for every dollar of current liabilities, I have X dollars of current assets. So obviously, if the ratio is 1.0, that's not particularly comforting. That means you have exactly the amount of assets necessary to pay off your liabilities, and that's cutting it a little tight. So generally, we like to see higher ratios than 1.0. The kind of rule of thumb historically has been 2.0, but well-run companies can function very smoothly even below 2.0. But definitely, if you're below 1, you're in trouble. If you're above 2, you're in good shape. And if you're between 1 and 2, you should look at what's going on and what's causing it to be at that level. For our sample company, Microdrive, we can look at the ratio. On the right, you'll see here that so this section here represents the ratio. And where do we find this information? Current assets are found on the balance sheet in the top section. Current liabilities are found in the balance sheet, again, the top section, the ones that are due within 1 year. The ratio is very simple. You take one number divided by the other. In this case, we ended up with Microdrive being 2.0, but that doesn't mean anything. 2.0 compared to what? It's most useful when you have an industry average. So now we see a couple things. By kind of general standards, 2.0 is pretty good, right? It's double the amount of current assets in excess of the current liabilities. So that feels pretty good. However, compared to the industry, it lags a little bit. The industry is actually in more healthy shape at 2.2. We're 2.0, a little bit less safe than the industry, but certainly not bad. The next test, which is below here, is called the acid or quick ratio. And this particular ratio is similar to current, except it excludes inventory. So we take the current assets as we did in the current ratio, subtract inventories, use that as the denominator, and then divide by current liabilities. So you can see the ratio right here. And it's very similar to the current ratio, but it's more stringent, and that's why it's called acid test. In this case, Microdrive is 0.7, and industry average is 0.8. And again, rules of thumb historically have said 1.0 is healthy. Same caveat, if it's below 1, then you could look at other practices to make your determination if there's a problem or not. Here, the industry doesn't function very smoothly either. It's at 0.8. And again, microdrive is worse, is lower, and we want this number higher, right? The higher, the more assets you have, the better. Next, we'll look at asset management ratios. So these look at how well we manage our assets, usually seen as how much sales do we generate for a given amount of assets, or how much money do we make from a given amount of assets. So this is asset management ratio. The first we'll look at is at the total level, total assets turnover ratio, and that answers the question, for every dollar of assets, how many dollars of sales do we generate? And again, applying it to microdrive on the right side, we see the ratio. It's a very simple one, and this ratio is sales over total assets. Sales, you know, we can get from the top of the income statement. Total assets we get, of course, from the balance sheet. For microdrive, their ratio is 1.2 compared to industry average of 1.8. And here we want higher numbers. In other words, for every dollar of assets, we want a lot of sales. So in this case, that the microdrive at 1.4 is lower, pretty significantly lower than the industry average of 1.8. That would be kind of a question mark or something we would be concerned about. The other one is fixed assets. So the fixed asset turnover ratio is very similar. However, we're just looking at their property, plant, and equipment. And the ratio, again, is simple. It's sales, but now we're going to divide by net fixed assets. Again, as we discussed in class last week, net fixed assets is equivalent to property, plant, and equipment minus accumulated depreciation. For microdrive, that ratio is 2.5 compared to the industry of 3.0. So once again, microdrive is not as strong as the industry generally. It only generates $2.5 per dollar of fixed assets compared to the industry at 3.0. The next set of ratios are in the same overall category of asset management, but we're going to probe at different assets. Here, the first one is day sales, and day sales relates to receivables, and it answers the question of our customers pay us in how many days. And here, the formula is a little bit more complicated. We take receivables, and for our purposes for this book, we use the ending accounts receivable balance, and we divide it by annual sales divided by 365. In other words, 1 day's worth of sales. So the result is, in this case for microdrive, 37 days. It means for every receivables, how long does it take us to collect? And the answer is it takes us 37 days. That's not too bad because normal commercial terms are net 30. So that they're at 37 is not horrible. Compared to the industry, however, they're lagging a bit. The industry is right at 30 and they're at 37. So again, in absolute terms, 37 isn't a horrible number, but yes, once again, microdrive is underperforming versus the industry. The next one is not in the book, but I like the format of this because it's easy to interpret, similar to what we just did in receivables. And it's called days sales in inventory. So again, it's very similar in name and computation, and it answers the question, how long does it take you to sell your inventory? So that's an important question. The formula is inventory, and again, we'll use ending inventory, divided by cost of goods sold, divided by 365. For microdrive, when we do the calculation, 31.25 days, compared to the industry at 73 days. For microdrive, it takes about 93 days to sell their inventory. That's pretty slow. That means we hang on to our inventory for 3 months prior to selling it. Compared to the industry at 73. Again, not so great either, but microdrive is underperforming because the industry sells it in 73 and we sell it in 91, lagging once again.